Good afternoon, everybody. Now we are continuing about the property plant equipment LKAS 16 and measurement at recognition. So in the previous session we have discussed about recognition, and also we have already discussed about recognizing the initial cost and recognizing the subsequent cost. So we have already done, and we are discussing measurement. Under the measurement we are talking about measurement at recognition, and also we are discussing still elements of cost. What are the elements of cost? And we have discussed these slides yesterday, and now we have to discuss the illustration 7. So illustration 7, it says, on the 1st of March 2018, the ABC Limited acquired a machine from XYZ Limited under the following terms. So it's purchase, right? It's purchase. So the list price of the machine, the price is 82,000. Import duty, so it's obvious it is directly attributable to the cost. And delivery fees, so we can include the delivery cost. And electrical and installation cost, so it's a directly attributable cost. And pre-production and testing cost, so we have to include this cost because it's pre-production. So they have spent this amount of money to make the machinery for the intended purpose, to make the machinery to the intended conditions, and right. So they have make a contract. The value of the contract is 7,000. It's valid for 5 years. So if there are any interruption in the machine, so these parties will come and do the repair. So it's obvious that this is not a part of contract, an element of cost. In addition to the above information, ABC Limited was granted a trade discount of 10%. So this is the list price. So we have to deduct a 10% trade discount. 10% trade discount we have to deduct of the asset, and settlement discount 5%. Settlement discount is 5%. It's a cash discount, right? It's a cash discount when the entity pays, when the ABC Limited pays to XYZ with regards to the purchase of the machine, they will give 5% discount if payment for the machine was received within 1 month of purchase. So ABC Limited paid for the plant on 25th March 2018. So they purchased on 1st of March and they have settled the money 25th, so it is falls within the 1 month period. So the entity is entitled to get this 5% discount. Anyhow, this 5% discount is a cash discount, so this cash discount will be treated as a income, right? As income, and it is not we want to deduct this 5% discount from this cost. So therefore the cost include the cost elements with regard to this machine is list price, import duty, delivery fees, electrical installation cost, pre-production, testing, and that's all, right? How should the above information be accounted for the financial statement? Right, in accordance with LKAS 16, all costs required to bring an asset to its present location and conditions. Its present location for its intended use should be capitalized. Therefore, the initial purchase price of the asset should be, right, list price 82,000, and we have to deduct the 10% trade discount, that is equal to 8,200. Therefore the cash price is equal 73,800. So we have to include import duty, delivery fees, electrical installation cost and pre-production testing cost. So we add all these costs to this 91,750. So this cost will be treated as a cost of the machine. Cost of the property plant account is 9,750 and case price 91,750. The maintenance contract of rupees 7,000 is an expense and therefore should be spread over 5 years. So the 7,000 should be charged spread over 5 years. They have purchased the freehold land for 4,500 million. So 4,500,000. Architect fees 620. Site preparation, material cost, direct labor cost, legal fees and general overhead. So all these costs will be considered as an element of the construction, but the general overhead cost cannot be included since it's a operating expenses. So the general overhead cost cannot be charged to the cost of the construction, and also it is not a directly attributable cost. The store was completed on 1st of January 2018. Here starts on 1st of April 2017 and the construction finished on 2018. So therefore, how many months? April, May, June, July, August, September, October, November, December. So almost it takes 9 months to make a complete the construction. Deferred issued 25 million unsecured loan on 1st of April 2017. The construction started on 1st of April and they have used issued unsecured loan on 1st of April 2017 to aid the construction of the new stores, which meets the definition of qualifying asset. The total loan carried at an interest of 8% per annum and 2020. Calculate the amount to be included as property, plant, equipment with respect of the new stores and state what impact the above information would have on income statement, if any, in the ended year 31st March 2018. So the construction is completed in 2018. Let's see the answers. So here we have to include the freehold land and architect fees, site preparation cost, material cost and direct labor cost, legal fees, the borrowing cost. It was completed January 2018 and use of the grand opening 2018. So completed, right? It was completed in 2018 January. So them have issued unsecured loan on 1st of April. So at the time of start the project, they have issued the loan, unsecured loan, to aid the construction of new stores, which meets the definition of qualifying asset, case 23. The loan carried an interest of 8% per annum and it's repayable on 1st of April 2020. So what the case is, so they have issued a loan on 1st of April 2017 and it ends, the period ends on 31st March 2018, but the construction has completed at this point, that is 1st of January 2018. So the period is 9 months here, and the remaining period is 3 months. So the interest is paid for all years. Interest is paid how much? So 25 million into 8%. So that is for all years, but we have to capitalize only for 9 months. So this 9-month interest cost can be included as a cost, but this 3-month interest cost cannot be capitalized with the construction of new store, and this interest cost for this 3 months will be charged as a cost, interest expenditures, not the capitalization. Right here the borrowing cost is 8%, so we take here for 1st of March 2018, Zebra PLC purchased an upgrade package from a plant at cost of 18,000 for the machine it is originally purchased in 2007. The upgrade took a total of 2 days, where new components were added to the machine. Zebra PLC agreed to purchase the package as a new component. Would lead to a reduction in production cost, right? So once they fixed the new component to the existing machine, they can reduce the production cost. The new component lead to reduction in production time, right? Reduction in production time, so therefore it will save the cost. So reduction in the production time for per unit 15%, it's a significant amount. So this will enable Zebra PLC to increase the production without need to purchase a new machine. So this is the scenario. The question is, should the additional expenditure be capitalized for expense? So the question is whether this 18,000 should charge in the income statement or the property, plant, equipment. So there are two conditions here. So once they spend 18,000, it will increase the production capacity, and also it is expected to use more than 1 year, so it can be this 18,000 cost can be charged with property, plant, equipment. The 18,000 should be capitalized as part of the cost of asset, as the revenue earning capacity of the machine has significantly increased. So due to the fixation of this package, so this part, the operating capacity has increased significantly, so which could in turn lead to the inflow of additional economic benefit, and the cost of upgrade can be reliably measured. So those two conditions are met, therefore this 18,000 can be charged in the property, plant and equipment. Now we move to the second part of the measurement. The first part is element of cost. Now we move to the measurement of cost, how to measure the cost. So first thing here under the measurement, here we measurement recognition, we already discussed this part. Price, equivalent and the total payment is recognized as interest, right? So if the entity is delayed to make the payment, say for example at the time of purchase they have to pay 10 million, but they made delay, right? They are delaying in making this 10 million payment, and so consequently they are paid 12 million, so because of the delay. So in these instances, this additional 2 million will be charged as a credit cost, the interest cost. This 2 million is not part of the item of property, plant, equipment. right? So the cash price at the time of recognition, at the date of recognition, will be taken price. If payment is deferred beyond the normal credit terms, the difference between the cash price equivalent and total payment is recognized as interest, right? This is the cash price, so this is total they paid including interest. So the difference, this 2 million, will be charged as interest. So the period of credit unless such interest is capitalized in accordance with LKAS 23. So this assume that it is not arised is not arised, this interest is not arised to construct the constructed by the asset, so it cannot be capitalized, so it is not part of LKAS 23, no relation with 23, LKAS 23. Alright, now we move to the acquired through exchange of transaction. So normally assets are purchased on cash or cash equivalents. Sometimes they are purchased, entities purchase equipments, property plant equipments, by exchange of old assets, exchanging the existing assets to the next new assets. So when entities purchase assets on cash, so it is not much challengeable to the accountants. It's not much challengeable, but in case of the exchange, they are bringing new assets for existing assets, so they're replacing. New asset will come into the organization and old assets will be exchanged for that. So one or more items of property, plant and equipment may be acquired in exchange, right? In exchange for a non-monetary assets or a combination of monetary and non-monetary assets. So cash is a monetary assets, check is a monetary assets, but machine A is not a plant A, or plant B is not a monetary assets, right? So if they purchase using monetary assets, it's very simple to find the cost. The following discussions refers simply to an exchange of one non-monetary assets for another, but it also applies to all exchanges described in the preceding sentence. So what they are doing is, so they purchase new machine for old machine, right? So this machine, the old machine will go out and the new machine come in, right? The cost of such an item of property is measured at fair value, right? So the new asset will come into the organization when they have to measure the value of the new asset on fair value, right? Fair value, unless, so there are two conditions, unless the exchange transactions lack in commercial substance, and the value, the fair value, recognize the asset given up, the whole asset. So even though the entity is fails to de-recognize the asset immediately, in case of exchange, they have to measure the value of new assets, acquired assets, to the exchange. If the acquired item is not measured here, if the acquired item is not measured at fair value, it has a fair value, the cost is measured at carrying amount of the asset given up, right? In case the new the value, the fair value of the new items is not measured fairly, then they have to go for the next option, is the carrying amount. Carrying amount mean what? Book value minus accumulated depreciation. So first they have to choose the fair value. If there is no fair value, reasonable measured fair value, then they go for carrying amount of existing assets, exchanged assets. So here the order of preference for measurement of cost during the exchange transactions. So first, what are the it's the order of preference. First, they look for the fair value of asset given up. The first choice, say for example, here asset A is a new asset. It's a new asset, and asset B is an old asset. So this asset will come into the organization, and the asset B will go out from the organization. Here the first choice, the first option is the fair value of the asset given up. So the asset B will be given up. So if we know the fair value of the asset B, then we have to take this value. And if the entity is unable to find the fair value reasonably of this asset B, then they have to choose the second option, the fair value of the asset acquired. So then in case of the fair value, absence of fair value of B, then you choose the fair value of A. In the situation where the entity does not have reasonable fair value of the asset given up and asset acquired, then the last option, the third option, is carrying amount of asset given up. So if we don't have, the entity does not have the fair value of the asset B, does not have the fair value of A, then they have to choose the carrying amount of the asset B, carrying amount, book value minus accumulated depreciation, right? An entity determines whether the exchange transaction has commercial substance. Commercial substance means it should give a significant changes in cash flows. So for example, you already use machine B, so old machine B, now you exchanged the new machine. Now you take the entity has taken a new asset A. So because of the new machine, the operating capacity of the entity has increased. So therefore the entity has enjoyed an abnormal profit, right? So it's a commercial substance. But in case, say for example, after the replacement exchange of the asset, there is no significant changes, there is no significant differences in cash flows. So in that instance, we can say that there is no commercial substance. There is no commercial substance, or the lack in commercial substance, because after the acquisition, after the exchange and before the exchange, the cash flows are not significantly different. In that case, there is no commercial substance. An entity determines whether an exchange transaction has commercial substance by considering the extent to which the future cash flows are expected to change as the result of transaction. The exchange transaction substance, if the exchange transaction has commercial substance, if number one, the configuration, risk, the risk, the certainty, the timing. So when the cash flow occurs, the amount, how much, the configuration of risk, timing, and amount of cash flows of the asset received differs, right? It differs from the configuration of cash flows of asset transferred. So old assets and new assets, when they exchange, when the transaction happened, there should be a significant differences. So in that case, we can say that there's a commercial substance, and the entity's specific value of the portion of the entity's operations affected by the transaction changes as a result of the change here. So this is the company, this entity, this is part of the operations. This is a part of operation. This part of operation. Now they have exchange an item. Exchange. So it's mean they acquired new machine. So due to that, the changes, due to the exchanges, the portion, the specific value of this portion has significantly increased, significantly changed. So in that time also, commercial substance, the entity specific value of the portion of the entity's operations affected by the transaction changes as a result of the exchange, right? So the difference in A or B, this A and B, is significant related to the fair value of the assets exchanged, right? The difference should be significant, noticeable material difference. For the purpose of determining whether an exchange transaction has commercial substance, the entity's specific value of the portion of the entity's operations affected by the transaction shall be reflect the post cash flows. Post cash flows mean what? Profit after tax. Profit after tax. Very easy, right? Compare, right? Compare the cash flows. So this cash flows before. So when the entity use the old machine, how much cash flows? Say for example 10 million. Net profit after tax is 10 million. And after acquisition, after the exchange, okay, new machine. Now the profit after tax is 20 million. And also after the acquisition of new asset also 10 million or 9.2, 9.8 million or 10.1 million. So if it is not significantly different, then we cannot say that it has a commercial substance. The result of this analysis may be clear without an entity having to perform detailed calculations. The fair value of an asset for which comparable market transactions do not exist is a measure if the variability in the range of a reasonable fair value estimates is not significant for that assets, or the probabilities of various estimates within the range can be reasonably assessed and used in estimating fair values. If an entity is able to determine reliably the fair value of either the asset received, asset A is a new asset, asset B here in the case of B, but unless the fair value of the asset received is more clearly evident. So it means, so the fair value of the A is highly dominance. High dominance mean very liquid, right? In the market, you can instantly sell the new asset in the market. So it's mean the fair value of A is dominant over B. So in these instances, they have to choose the fair value of the new assets. Here, the fair value of the asset received is more clearly evident. The cost of an item of property, plant, equipment held by lease under the finance lease is determined in accordance with LKAS 17 leases. The carrying amount of an item of property, plant and equipment may be reduced by government grant in accordance with LKAS 20, accounting for government disclosure of government assistance. We work out with an example. So Bio PLC acquired 31st December 2018 the asset X So new asset is X from company Agro PLC by transferring the ownership of the portion of the land and building which was purchased in 2009 at 40 million. So this 40 million consists of two components. A land component, that value of the land is 20 million, right? So the land and building, total value of land and building is 40 million. This 40 million was also known that fair value of the land and building on the date of transaction was 45 million. This means the 45 million is the value of asset given up. Value of the fair value of the asset given up is 45 million. You are given the following situations. Situation 1, the asset X, the asset given up, the asset received, the asset X that Bio PLC acquired cannot be determined at fair value. So these instances we have to, obviously it's clear, we have to take the fair value of asset we given up, the entity given up. So we have to take the fair value of the asset, fair value of the land and building. So that is 45 million. We need fair value. So here there is no contradiction because the new asset X, the old asset land. Here the fair value of X is not available and the value of land, fair land is available. Obviously is available. Then without any doubt we can choose the fair value of the asset given up. So that is 45 million. Situation 2, the asset X that Bio PLC acquired can be sold. The new asset, right? The new asset X, the acquired can be sold at 40 million on an arm's length transaction immediate after getting the asset, million. So this instance here 40 million as the cost of the asset. It's the cost of asset because the asset received, the fair value of asset received is dominant over the fair value of asset given up. Here look at determine as of 31st December 2018 with justifications in the context of LKAS 16. The carrying amount of asset X to be represented in the financial position statement of Bio PLC in the above two situations, assuming that the transaction has commercial substance. So in case of commercial substance, for the first situation we have to take 45 million. The value of the asset, new asset, is 45 million because the fair value asset given up is 45 million. So we have to take that value. So in the second situation, the arm's length transaction, so the new asset can be sold for 40 million. So it's dominant over the asset given up. So now we can take receipt. So in case of no substance, there is no commercial substance, the carrying amount of asset X to be represented in the financial position statement of Bio PLC in the above two situations, assuming that the transaction has no or lacking commercial substance. Here the first question has a commercial substance, second situation it has no commercial substance. So in that instances we have to go for the third option. What's the third option? We have to take the carrying amount. So what is the carrying amount? Here 40 million for building. So this balance 20 million. Here the building can be used for 20 years. So how many? It was purchased in 2009 January and it is 2018. How many years? 10 years. So 1 year depreciation equal, so 20 million divided by 20. So 1 year depreciation is 1 million. So this building is owned for 10 years, therefore depreciation, accurate depreciation for the building is 10 million, therefore the carrying amount of the building is 10 million. The carrying amount of the land is 20 million. So therefore the carrying amount of the asset given up equal 30 million. So therefore in both instances we have to take 30 million as the asset, value of the asset. Here this is the answer. The first situation is 45 million, second situation is 40 million, and there is no commercial substance, we have to take the carrying amount. So this is the decision chart. So cost of an item acquired by transferring other assets. So option 1, this is option 1, item is given up. The second option, fair value of the item acquired, new assets. The third option, carrying amount of the item given up. So we have to choose which one. So here the situation, you can choose option 1 when the exchange transaction has commercial substance and both fair value of the assets given up and received, or only asset given up is reliably measured. When reliably measured, here the dominance is the asset given up. Dominance is asset given up. So therefore we can take the fair value of asset given up. Fair value of the asset given up we can take. In the second option, the fair value of the asset item acquired, new asset. Which condition? The exchange transaction has commercial substance, but the fair value of the asset acquired is reliably measurable. Only the fair value of the asset acquired is reliably measurable, or the fair value of the new asset, acquired asset, dominant over existing asset given up. So that